Thank you for joining us at XM.com. In this preview video, we'll be looking at Thursday's inflation report, which is likely to be the dollar's next big test. I'm Christina Marucos. With me today is our senior investment analyst, Charalambos Pissouros. Charalambos, apart from the dollar, though, the CPI report will be important in shaping the market's expectation regarding the timing of the Fed's first rate cut. What do you think we'll see in the numbers?
Hello, Christina. Indeed, the market has been eagerly trying to figure out when will the Fed start cutting rates. Friday's mixed jobs numbers for December and the disappointing ISM non-manufacturing PMI for the month allowed participants to maintain bets of aggressive rate cuts by the end of the year, and a 60% probability that the first quarter point reduction will be delivered in March, despite the Fed pointing to much fewer reductions through its December dot plot, and the minutes of the latest meeting revealing that most policymakers wanted to keep borrowing costs high for some time. Now, as you said, attention will fall on Thursday's CPI numbers for December. Headline inflation saw a faster slowdown than underlying price pressures in recent months as energy prices began drifting south in September. However, with the 2022 downtrend now dropping out of the year-on-year calculation, the year-on-year change in oil prices has moved from well into negative territory close to zero, which means that there are upside risks to the headline CPI rate. Indeed, the forecasts support this logic. We have the core rate expected to have declined to 3.8% from 4%, but the headline rate is seen ticking up to 3.2% from 3.1%. A rebound in the headline CPI rate and a core rate still nearly double the Fed's objective may convince investors to push back their bets regarding a March rate reduction, even if they don't materially reduce the total amount of basis points expected to be cut by the end of the year.
And now let's turn to the market reaction. The dollar paused its rally after the NFP report on Friday came in better than expected. Can the CPI data, though, help it resume its rally?
Yes, the headline numbers of the US employment report were better than expected, but digging into the report, the details were not that encouraging, with the October and November NFP prints being revised notably down and the participation rate sliding. What's more, the ISM non-manufacturing PMI for the same month fell to its lowest reading since May, with the employment sub-index tumbling to its lowest since July 2020. As I already mentioned, these numbers allowed investors to continue pricing in a decent 60% probability for a March cut, but that's a notable reduction if we consider that such an action was nearly fully priced in on January 2nd, the first trading day of the year. Therefore, a rebound in inflation could prompt market participants to assign an even less chance for a March cut, which could result in higher treasury yields and could thereby help the dollar resume its latest recovery.
Charalambos, thanks so much. This was a preview video. The CPI report is out on Thursday. Thanks for watching at XM.com.